What's up, everybody? This is Sunko, the Korean Bro. Today is 2024, April 3rd. What I'm going to do tonight is read articles posted on Yahoo Finance. Um, just today afternoon, I heard a news about Tesla. Having trouble. But we'll see what happened with Tesla because I still haven't looked at the news yet, and we'll see. Okay. Hmm. Tesla won't be easy to fix. Here's how far the stock could fall. Okay, let's see. Uh, Wait, hold on here. Okay. Shocking is that Tesla is underperforming GM by 58.6% in 2024. Um, Why EV stock Tesla, Rivian, Lucid all fell today, April 2nd. Hmm. Okay, shocking. Tesla is underperforming GM by 58.6%. Hmm. Gordon Johnson expects Tesla stock to fall nearly 90%. In his view, the EV maker is vastly overpriced given its output and sales. It's recommended as a top short by a small research firm. For the most part, analysts tend to be rather cautious and reserved when setting their price targets for stocks. That isn't the case with Gordon Johnson at GLJ Research. He was very bearish on Tesla. Johnson expects shares of the electric vehicle industry leader to lose close to 90% of their value. Tesla is a prime short sale candidate, says analyst. Near the end of March, Johnson reiterated his sell recommendation on Tesla with a $23.53 per share price target, far below the company's Monday closing price of about $175 per share. With that kind of anticipated decline, Johnson has tagged Tesla as his firm's best short recommendation. In research note, Johnson pointed out that Tesla's $558 billion market cap is larger than rival car makers Toyota and BYD combined, yet Tesla sold merely 16% of the automobiles those companies did in a trailing 12-month period. Although the analyst left his recommendation and price target unchanged, he did revise his estimate for Tesla's first quarter vehicle deliveries from 417,500 to 406,500. That's far below the consensus analyst projection of 462,200. Unplugging from EVs. Okay, Johnson's take on Tesla is extremely bearish, but it tracks with recent developments. Overall, EV sales growth has slowed. And CEO Elon Musk is frequently featured in headlines for various controversies, with shares down 60% from their all-time high. The glitter has come off Tesla stock for the time being. The company will need to deliver on big promises like its next generation vehicle platform to win back investor confidence. But even if Tesla faces new delays and challenges, Johnson's price target remains an extreme outlier, and shorting a stock comes with a significant risk, meaning this strategy isn't appropriate for many investors. So this guy, small research firm, doesn't have, you know, rosy outlook uh, for Tesla, and it says it's going to even fall close to 90% of their value. Hmm. Okay, let's see. Tesla lost a week of production at its Berlin factory due to an arson attack. Several analysts issued bearish notes on the stock. The company announced a surprising price hike on the Model Y. An arson attack and continued EV headwinds weighed on Tesla. March was another tough month for Tesla as the leading electric vehicle maker continued to face challenges related to production and demand. There weren't any major reasons for the sell-off, but analyst sentiment on the stock seemed to sour heading into its first quarter earnings report later this month. And the company was forced to temporarily shut down a German factory after an arson attack on the electrical grid. According to data from S&P Global Market Intelligence, the stock fell 13% last month. As you can see from the chart below, most of its losses came in the first half of the month. Tesla's struggles continue. The biggest event seemed to be the power outage at the Berlin Gigafactory as it lost power for a week starting on March 5th. This was one of the factors pushing the stock lower in the beginning of March, and negative sentiment from Wall Street also seemed to weigh on the stock as well. Citigroup, for example, said the first quarter results seem likely to come in below consensus as analyst Italy Merkley said it's tough to get bullish with consensus still high, but said the Model 3 refresh would help. Wells Fargo, meanwhile, downgraded the stock to an underweight rating due to price demand and valuation concerns and gave it a price target of just $125. The bank also noted the volume and earnings were likely to disappoint this year. The valuation sets the stock up for a fall. In the middle of the month, Tesla stock got a modest rebound after the company said it would raise prices on the Model Y by 2,000 euros in some parts of Europe on March 22nd and by $1,000 in the US by April 1st. The move seemed to be a sign of confidence from the company or a shift in the strategy to prioritizing profits. However, Deutsche Bank said the move was a ploy to increase first quarter sales since prices would go up after the quarter ended. Tesla with some quarter first deliveries. April is just getting started, but Tesla is already down 5% after posting disappointing deliveries for the first quarter. Tesla's delivery fell 9% from the quarter a year ago to 386,810, and it produced 433,371 vehicles. It went weaker than expected. Production numbers on the ramp up its updated Model 3 and shutdowns related to supply chain delays from the Red Sea attacks and the aforementioned arson near its Berlin factory. Tesla will report its full first quarter earnings on April 23rd, which is likely to show declines in both revenue and profits. What would be a mistake to count on out Tesla over the long term, investors seem to be in store for a challenging 2024. In fact, Tesla was the worst performing S&P 500 stock in the first quarter. Okay, I get it. So there are a lot of bearish outlook on Tesla. Mhm. Remains the premier brand name in the electrical vehicle market. Demand, however, is slowing down. At the same time, it's getting crowded. Investors may find a more compelling risk versus reward prospect elsewhere. Okay, let's see. It's been more than 20 years since Tesla was founded and 50 years since it made its first electrical vehicle. It's been a mainstream, mass-produced brand of cars over a decade, in fact, and yet the evolving company is still making as many headlines now as it ever has, maybe more. And not all of these headlines are bullish for Tesla stock, mind you. The EV manufacturer, along with CEO, seem to be on the defensive these days. That's a big reason why Tesla stock is down by more than 50% from its late 2021 peak. It's still teasing a new 52-week low. The sell-off and all the drama causing it are keeping investors guessing as to what's next for the story company. If all of this uncertainty is making it difficult for you to make a decision on your stock, it's time to take a step back and look at the bigger picture. Here's what matters most about Tesla for better or worse strength. it's still the most revered brand. Okay, let's face it, while lots of other manufacturers now are making electrical vehicles, Tesla remains the premier brand in the business. Not only did the Kelly Blue Book name it as 2023's brand image winner among EVs, but Tesla also top long established makers of combustion powered cars in several different luxury vehicle categories. Its reputation is similar overseas as well. The well respected name certainly helps keep Tesla at the top of consumers' minds when they are in the market for an electrical vehicle. Highly integrated production. Okay, many car makers handle a good deal of their manufacturing process these days. Few car makers, however, do as much in-house as Tesla does. From us stamping its own aluminum chassis to assembling its cars and manufacturing its own battery packs, this company can customize every facet of EV production. Not only does these make it easier to build a new car from the ground up, also means Tesla isn't waiting on parts from a third-party manufacturer that may be unexpectedly delayed. And focus and fiscally flexible as Reset. Yes, the company makes at-home energy storage solutions along with solar panel shingles. These aren't exactly distracting side projects, though. This is to say Tesla remains 100% focused on making some of the world's very best electrical vehicles. That's in contrast with traditional combustion powered car makers like Ford Motor Company and General Motors, which are struggling to manage waning demand for gas powered vehicles at the same time they're investing in their nascent EV businesses. Okay, this transition is proving expensive for an already fiscally beleaguered auto industry, with the exception of EV-focused Tesla, which has been consistently profitable since 2020. This profitability allows the EV maker to maneuver as needed. Okay, so focused, fiscally flexible as Reset. Diverse product lineup. Finally, although this wasn't always the case, Tesla now offers a vehicle for every budget. Its lowest priced cars soar in the ballpark of $40,000, while consumers looking for more luxury or better performance can spend over $100,000 on Tesla and still get their money's worth. Finally, although this wasn't always the case, Tesla now offers a vehicle for every budget. The lowest priced cars soar in a ballpark of $40,000. While consumers looking for more luxury or better performance can spend over $100,000 on Tesla and still get their money's worth. Of course, there are plenty of options in between those two extremes. This wide range of price point means Tesla's got some to sell to anyone willing and able to own a car. Witnesses. Elon Musk drove sometimes contrasting reviews. Not everything is worrying to Tesla's advantage. There are matters that should concern prospective shareholders. Here are four top challenges this time. There were a time when Chief Executive Officer Elon Musk was lauded as visionary, was saving the world by mainstreaming clean, environmentally friendly automobiles. Perhaps not as much now, ever since his 2022 acquisition of Twitter and subsequent questions about certain kinds of online speech. Musk has been a bit in the hot seat. It's not a stretch to wonder if his well publicized comments may sometimes be adversely impacting Tesla's stock price. Not enough owner support infrastructure. Most Tesla owners love their cars, but owning them isn't always convenient. There's this lack of ways to charge your batteries away from home. As Molly Fool's own research indicated, there are only 1,174 Tesla charging stations supporting uh peppered across the United States, and most of those are found in the more metropolitan areas. For perspective, the National Association of Convenience Stores estimate there are on the order of 145,000 gasoline filling stations in the U.S. each with several pumps they can fill up a cause gas tank in a matter of minutes. Things aren't remarkably different outside of the United States either. For anyone driving a Tesla on a lengthy trip, it takes quite a bit of careful planning. Internet interest in electrical vehicles is peaking. This recharging war is a big reason that interest in purchasing EVs is slowing. Although it's not the only reason, the end of subsidized wars about the sky high cost of replacing EV batteries and the still lofty price of electric vehicles are all part of the reason US consumers' interest in owning an EV has fallen from 49% of late 2022 to 41% now, according to a recent report from the Jerry Data Company. The same trend is evident overseas. Competition is getting serious. Okay. Last but not least, at the same time, the consumers are facing falling out of love with the idea of all electrical vehicles. Tesla's top competitors are stepping up their games. Sales of China's BYD electrical vehicle eclipsed Tesla made EV sales during the final first quarter of last year. Domestically, General Motors is taking with its plans to altogether stop making combustion powered vehicles by 2035. Ford is slowing its electrical vehicle plan down just a bit, although it still intends to begin manufacturing a battery powered version of its popular Explorer SUV in the middle of this year, with the debut of another new EV plant before the end of 2024. Okay, so I get it. So there are a lot of controversies over Tesla. Hmm. It's all understandable. Hmm. Okay, the S&P 500 index entered April at an all-time high. Many individual stocks continue to trade below their best ever levels. This suggests an opportunity for investors. Sending one in DigitalOcean are solving important problems, and that could translate into long-term upside. That's what they are. Sending one, business operate online more than ever thanks to cheap digital solutions offered by cloud computing platforms. What empowers them to reach a global customer base and streamline their day-to-day tasks, it makes them an easy target for cyber criminals who launch attacks around the clock. Human cybersecurity managers simply can't keep up with the sheer volume of threats that organizations face. Alert fatigue is one of the industry's most serious problems. Palo Alto Networks estimate that 23% of security incidents are left uninvestigated because of it. Hmm. Sentinel One offers a portfolio of artificial intelligence powered cybersecurity products to help solve that challenge. Its Singularity platform features endpoint identity and cloud solutions that proactively hunt down and neutralize threat as machine speed. Sentinel One storyline technology then pieces incidents all together to autonomously create a summary for cybersecurity managers, significantly cutting down the amount of time they have to spend on manual investigations. And now let's go over to DigitalOcean. Hmm. The cloud computing industry is dominated by trillion-dollar tech giants like Amazon, Microsoft, and Alphabet. However, while those market leaders are busy chasing the largest contract, DigitalOcean is building an incredible platform to serve small and mid-sized businesses. It focuses on what startups and SMB actually need, including cheap and transparent pricing, highly personalized service, and thousands of items of educational material to help them get the most from their cloud experience. Those features are critical because the ocean's typical client doesn't have the budget for an in-house technical team. DigitalOcean offers customers a range of cloud solutions, from a simple data storage and website hosting to complex tools for software development and video streaming. But thanks to its $111 million acquisition of Perspective last year, it also provides an expanding of suite of AI solutions that might otherwise be reserved for much larger enterprises using cloud providers like Amazon or Microsoft. Paperspace operates specialized data centers designed to process AI workloads. Okay, let's see about Occidental Petroleum. Why would Warren Buffett buy this product? Because he believes in the future of the United States. Occidental Petroleum has nothing to do with high technology. It's more to do with oil, gas, that the natural gas that the states have. Okay, the large stock Buffett mentions is one Berkshire plans to hold indefinitely is Occidental Petroleum. It's a relative newcomer to Berkshire's portfolio. Buffett established the positioning Occidental in 2019 by buying $10 billion worth of preferred shares to fund the overaccomplished acquisition of Anadarko. In 2022, he started accumulating shares of the common stock, and Berkshire now owns 28% of the shares outstanding. Software companies figured out about decade ago that locking clients into subscription services is a much better business model. Clients have to make a painful choice if they break the subscription, as they lose access to software altogether. Mm. Nvidia has seen demand for its GPUs plummet before. Cloud computing uses a lot of GPUs Renting out GPUs through cloud computing is a way to guarantee consistent revenue. About a decade ago, the logging clients to subscription service is a much better business model. Clients have to make a painful choice if they break the subscription, as they lose access to the software altogether. Before this, customers could choose to upgrade to the newest software edition, which may include some new features, but it wasn't always required. Now, nearly all software is subscription based, and even basic products like Microsoft Office should have subscription offering. Clearly, this business model has some advantages over single sale. When NVIDIA may be fine, I'm more confident in Amazon, Microsoft, Alphabet's ability to sustain their businesses over the long term due to their cloud computing segments. While these aren't the largest part of their businesses, they're critical components that will provide consistent subscription revenue. Okay, let's read this and then put an end to it. Okay, Amazon. Okay, when you look back in 5 years, you wish you had bought this trillion-dollar artificial intelligence stock. Amazon started out selling books online in 1994, but the company has expanded significantly. Amazon Web Services is the world-leading cloud platform, and it's home to many of Amazon's artificial intelligence initiatives. Amazon generated more revenue last year than all of its trillion-dollar peers. Its stock is the cheapest of the bunch. Amazon just closed its blockbuster deal with artificial intelligence startup Anthropic and remains the cheapest member of the $1 trillion club. Amazon began as an online bookseller when it was founded in 1994. E-commerce remains the company's largest source of revenue, but it has also expanded to other areas of the technology sector, included cloud computing, streaming, and digital advertising, and now artificial intelligence. AI could be one of the greatest financial opportunities in history, and Amazon is tackling it from a multiple angles. The company just made the final payment of its agreed $4 billion investment to leading AI startup Anthropic, a deal that will accelerate Amazon's progress on both the hardware and software sides. Amazon is one of six companies valued at $1 trillion or more, and all its peers have a presence in AI. However, Amazon generates more revenue than all of them, and yet its stock is the cheapest of the bunch. Here's why investors might regret not buying it when they look back on this moment in 5 years. Amazon is cementing itself as a leader in artificial intelligence. Amazon Web Services is the largest cloud services platform in the world. It offers hundreds of solutions to help businesses store data, operate digital sales channels, develop software, and build AI applications. Amazon's goal is to have AWS dominate the three primary layers of AI. The hardware layer comes first. Like most cloud providers, Amazon fills its data centers with NVIDIA's graphics processing units, which are the most powerful in the industry when it comes to handling AI workloads. However, Amazon also designs its own chips. It recently launched Trainium 2, which is four times faster and twice as energy efficient as the original Trainium chip, allowing developers to train the large language models far more quickly. LLMs sit at the foundation popular consumer-facing applications like ChatGPT. But some developers prefer to use existing LLMs so they can build AI applications more quickly. There's the second layer. AWS offers a variety of models, including its own Code-Titan and models from a leading third parties like Anthropic, Meta Platform, and Stability AI. Ready-made applications are the third and final layer. AWS offers Code Whisperer, which helps developers accelerate their programming. Then there is Amazon Q, a fully functional chatbot embedded in AWS. No two businesses are the same, so Q can be tailored to suit the task at hand to streamline projects, drive innovation, and speed up decision making. The Amazon Anthropic deal will accelerate progress on all fronts. In September 2023, Amazon Anthropic announced a strategic partnership. Amazon would invest $4 billion in a startup, of which the final $2.75 billion was transferred in March to close the deal. In exchange, Anthropic is helping Amazon accelerate penetration into the AI industry. Anthropic is a creator of Cloud, a generative AI chatbot. Its recent Claude 3 model reportedly outperformed competitors like OpenAI ChatGPT-4 models in most multimodal benchmarks. That means they are better at reasoning, solving math problems, answering complex questions, and generating content like computer code. Anthropic will use AWS as its primary cloud provider, or will also train its future AI models on Amazon's chips, which could entice other leading developers to use them instead of NVIDIA's hardware, which had become the default choice. Finally, Anthropic will make all of its models available in AWS for customers' use, which could be an advantage when developers are choosing a cloud provider. So, Amazon is the cheapest trillion-dollar stock by Symmetric. Amazon generated $574 billion in revenue in 2023, which was more than any of its trillion-dollar peers. Apple was the closest with $394 billion in sales during its fiscal 2023 year. Nevertheless, Amazon's market capitalization stands at $1.9 trillion compared to Apple's $2.7 trillion. The price sales ratio divides the company's market cap by its annual revenue. So in this case, Amazon PS ratio is 3.2. Anyway, this is it, and I'll see you guys tomorrow. Okay, see you and have a good night. Okay, bye bye.